Let's relive the past. It's the early 1970s. Bell-bottoms are in, the Watergate scandal is just a whisper, and on Wall Street, there's a party going on. A private party for about 50 companies. The cool kids, the Nifty 50. Names you still know today. IBM, Disney, Coca-Cola, McDonald's. And some you might not, like Avon. These weren't just stocks. They were gospel. They were seen as so perfect, so dominant, that you only had to make one decision: buy, and then never sell. Ever. And why would you? In 1972, their earnings were exploding, growing around 22% a year. The rest of the market, the S&P 500, it was lucky to get 13%. These companies were star athletes, and the rest were just playing in a local league. So investors, big institutions, did what people always do. They extrapolated perfection into infinity. They paid for it. By the end of 72, the average price-to-earnings ratio for the Nifty 50 was hovering around 43. The broader market was at 18. To put that in perspective for you, paying 43 times earnings is like buying a house and agreeing to pay 43 years of rent up front. You're betting that not only will the neighborhood get better, but that nothing, absolutely nothing, will go wrong for nearly half a century. McDonald's was trading at 54 times its earnings.
Disney, 51. The mantra on the street was, you can't be fired for buying IBM. It was the ultimate safety in consensus. And when everyone agrees on something in finance, you should probably start getting nervous, because the real world doesn't care about stock market parties. In October of 1973, the music stopped. Following the Yom Kippur War, Arab oil producers hit the U.S. with an embargo. Suddenly, the price of crude oil didn't just inch up, it quadrupled. It went from under $3 a barrel to almost $12. Think about that. The lifeblood of the entire global economy suddenly cost 4 times as much. Gas lines snaked around city blocks, and inflation, which was already getting warm, went nuclear. By late 1974, prices were rising at 12% year over year. The Fed started hiking rates, confidence evaporated. The long, slow slide began. And those one-decision stocks, the ones you buy and hold forever, they weren't a safe harbor. They were the epicenter of the storm. The S&P 500 fell about 14% in 73, then another 26% in 74. The Nifty 50 did worse, much worse. We're talking devastating drawdowns, 60, 70, even 90% losses. Avon, the cosmetics giant, cratered from $140 a share to about $18. That's not a correction, that's an extinction-level event for a portfolio. Coca-Cola dropped from nearly $150 to around $44. The Dow Jones, which had just cracked 1,000 for the first time, wouldn't see that level again for 8 years. A whole generation of wealth and enthusiasm just gone. And get this for contrast. While these can't-miss stocks were losing fortunes, the most boring investment imaginable, a T-bill, was yielding 8%. You could have made money by literally doing nothing. It's easy to see these as just big numbers, but in 1973, the median family income in America was about $12,000. A brand new house cost $30,000. These market losses weren't abstract, they were gut punches to real families. So what's the ghost in this story? The lesson that echoes down the decades. It's not that buying great companies is a mistake. Many of the Nifty 50, like Disney and Coke, went on to do incredible things. The lesson is brutally simple. Price matters. Even the best business in the world can be a horrible investment if you buy it at a price that already has a decade of perfect, uninterrupted sunshine baked in. Because eventually, it always starts to rain. And assets placed on the pedestal of popularity tend to fall the farthest. I hope you enjoyed this video. Try the following one.